So uh, before we get started on this, it's been a humbling year to try and talk about what's happening in the global economy because it changes by the day. And today we had Swedish central bank surprise the markets with a 100 basis point increase in their benchmark rate in advance of the Fed tomorrow. The Bank of England and the Bank of Japan are all queued up, and the ECB will come later. I get asked a lot about what I think is going to happen tomorrow. Is it 75 basis points or 100 basis points by the Fed? And in my view, it will matter for the day or for a couple of days, but it really doesn't matter much whether it's 75 or 100 because they're going to be raising a little bit more before the end of the year anyway. But I think you'll have some pretty volatile markets. We're seeing Dow was down 400 not too long ago. I think you'll continue to see that. We may be near a recession. We may be in one globally. This is really focusing on the different areas and what we think the outlook is. So the World Bank put out a report, and one of the quotes in the report was from Stephen Roach, and it's something that we talked about on last week's briefing. Europe, the US, and China make up about half of the world GDP, and each one of them has their own problems. I think the US a little less so than Europe and China right now, but it's very hard to see how you could avoid a global recession when you have those economies where they are. And we know the strains that are being felt around the rest of the world as a result with food and energy going on. So it's interesting. Web searches about recessions and global recessions, you can see how they spiked up we've had lately, the pandemic, the war in Ukraine, and also the great financial crisis. You see what's really picked up, though, as you can see from the chart, is the rise in searches for inflation and stagflation, which have really spiked up and really well beyond what we had seen in most of the last 20 years. So today I want to take a look at some lessons from recent recessions, where I think we are today and what I think the investment implications are. I have a few more slides than normal, so bear with me. I'll try and go through them quickly. There have been 5 recessions since the early 70s, and they each have a couple of characteristics that tend to go with them. It would start with either oil price spikes, major policy shifts like we saw with Volcker in 92, which was also the tail end of an oil price spike. It was also major policy shifts was one of them. The other thing is that you have significant tightening of conditions for a variety of reasons. So, and then you have the pandemic. So I think the financial crises are an element of it, and you can see how per capita GDP and GDP have flown from there, and we're really not in a great spot right now. This chart looks at what the amplitude of the recessions were during that period. The gold line is actually what per capita GDP averaged during those periods. So you can see it's a pretty wide band of outcomes that we've seen here, but this is clearly the worst one we've had of the recent ones. We also have had 3 downturns, and a downturn is really defined by the World Bank as really not really getting to the limits of a recession, but things slowed down, but they didn't crater. And as you can see, during the downturns, we had global GDP up around between 0.5% and 1.5%. And that each one of them had their own different elements, the 98 with the Asian crisis, 2001 with the tech bubble, and then 2012 with the European sovereign debt crisis. But during each of those times, somebody else stepped up and carried the ball. So in 98, it was the US. In 2000, it was the BRICS, and really China leading that out that helped us come out of the tech wreck. And then China again, with the US starting to rebound in 2012. So the downturns are not as bad. If we're going into what people are fearing, let's hope for a downturn rather than a global recession. But where are we today? You can see this right now. We have, this is a bad chart. If the blue line's growth going one way and inflation's going the other, you can see the magnitude of the change and how quickly it's changed in a 6-month period. And it really coincides with the invasion of Ukraine. And that's creating further distortions in the global economy, particularly around food and energy. This next chart takes a look at where we are and where we think we're going, where the World Bank thinks we're going relative to the past recessions in the band. And one of the things that's a little bit concerning is we are outside the band right now, where we think the change could go, and that could speak to the severity of it. I would just say that there's a lot of outcomes that could come out of this with a lot of wild cards, starting with the lunatics and governments all over the world, DC, Russia, Europe. We don't have the statesmen that we had, and quite frankly, we lost a major statesperson yesterday with the loss of the Queen. And while she didn't affect policy as much, she did carry some weight around how perceptions are of where the world is and how people should be behaving. So I think there's some real issues going on, and I think a lack of leadership is one of them that's putting us in this spot. This next chart looks at GDP under different scenarios. And the baseline scenario for 22, for the baseline scenario for all three periods is basically that rates rise, central banks tighten to try and offset inflation, but they don't go far enough to kill it. And that just prolongs the pain. A sharp downturn would be they start to act on inflation expectations, but don't take it all the way to cut the legs out of inflation. A global recession is really, if we see more of 100 basis point increases where the central banks really decide that they're going to stop inflation dead in its tracks and rebuild after that. And I'm not sure that any government or central bank has the appetite to kill inflation the way they need to right now. And I think that's could be one of the challenges. And it's one of the fears that we go back to what we did in the US in the 70s, where after a couple of years of tightening, we eased way too soon before we choked off inflation. I think that's one of the concerns that we have. The next chart just looks at the baseline and where we are in past recessions. And this one, their outlook seems to be a little bit more positive unless we go into a sharp recession, which is kind of in the core of the look. But this is not a great setup for the global economy. This last chart on global GDP that I'm going to show you looks at where we were pre-pandemic, what the pandemic did, and you can see the offset that created, and then where we're going from here. And I think it's in each of these cases, it's going to be a tough slog for the global economy. And the question is, who can lead us out of it? And there's not a lot of strong candidates. At least in 2000, we had the BRICS really taking off. And in 2012, China was continuing to stimulate. They got into the stimulating game, supporting the global economy because their two biggest markets were getting hit pretty hard at that time, the US and mostly Europe with the sovereign debt crisis. I think one of the interesting things that's happened is a move towards short-termism. And this chart on policy rate rises and cuts going back to the 70s, you look at the amplitude of the change and the number of increases in rate rises and cuts speaks to, I think, the short-termism that pervades our world today, whether it's corporate earnings. I think a lot of this goes back to when we started to shift towards much more quarterly earnings reports and the street reacting to what was going on. I think the central banks and governments started to react to that. And we stopped focusing on the secular challenges and just dealt with the cyclical ones. And those solutions were always usually suboptimal. You were cheating the spend on the really important stuff to kind of put a Band-Aid on a severed artery. And I think that's really what we've seen. And so I'm a little concerned that the magnitude of the central bank actions are so great, it's hard to get any consistent kind of movement towards solving the problems. And as you can see, policy rates are really unusual. You look at where we were and you'll see where we were in 22. And now you start to see global short rates are up almost 300 basis points in 6 months. And that's a major tightening on the global economy. And you just think about it, we're $300 trillion in debt globally at a 3% increase. And that's not a real 3% because they're different maturities, but say it's half that. You're on a $96 trillion GDP. You're taking 3, 4, 5, 6% or more to debt servicing when we have problems that need to be solved. And that's even before we get to rebuilding Ukraine and the other areas that we're going to have to put a lot of capital to. So I think this is a real challenge. And I think really speaks to a wasted opportunity by governments around the world to use low interest rates to solve secular problems. And we would be in much better shape if we did that instead of robbing Peter to pay Paul. And we're just doing this the wrong way. I think that goes back to the lack of leadership that we've had throughout. This next chart just looks at the rise in global debt. And we had a debt crisis in 2009 that we solved by layering on debt. And the idea by the central banks at the time was to defease the debt by increasing the value of assets. And we ended up with a rise in assets, and asset values did go up. Consumer net worth, I think, went up from about 51% during that 10-year period. Unfortunately, the debts grew from 200 trillion to 300 trillion in that 10-year period. Not a great setup either. So I think we're in this spot now where we're going to have a debt problem with us for a while. And I don't know how you get out of this without really getting superior growth. Then we're in a tough growth environment for what I think will be for some time. This last chart just looks at, I throw this in because Mark charts for people to look at it after. I'm not going to go through it, but it looks at what GDP did during the recessions in the world, advanced economies, and in the emerging market developed economies, and how that's evolved over the years and what it looked like in non-recession years versus recession years. So I'm not going to go into that. It's there for people who like to go fact check and the like. So where are we now? So Mark was right. I think this is a pretty bleak outlook right now for where we are in the global economy near term. But I think we have solutions for the long term, and technology is a big part of it. So I think opportunity is knocking right now with the volatility and uncertainty, but the need to be more selective than we have been at any point in time in the last decade, I think, is at its highest. And I think that goes back to the interest rates that we're seeing. The valuations on 0 interest rates versus 3% interest rates are quite different, and the math uses that, and it's across all asset classes. I think we talked about it in London, and when I was talking on the asset allocation panel, the discussion was, public markets. I think it's going to hit all of them. I think it's hitting some later, and until you get real price discovery in the private markets, which are slowly starting to get, I think you're going to have some real issues until we find our way through that. I think we're absolutely headed towards a slowdown. I'm not sure the U.S. gets there. I think we may avoid it or have a really shallow recession. I'm worried about China and I'm worried about Europe. And I think the China issue, the debt problems are very much internal, but housing is such a big driver for them. It's similar in some ways to the U.S. back in 08 and 09. And that's really what I'm worried about, is when you have 29, 30% of the economy in a really bad way, and the numbers coming out, the statistics coming out the last couple of days, a lot of stress on the local governments starting to get even more intense. So I think there's challenges there. We know the challenges in Europe, but I'm interested, Michael was saying earlier that the mood in Germany is not as negative as the perception is elsewhere. So maybe it's the press getting it wrong again, and we're too negative. But I think it's, either way you look at it, it's going to be tough sledding for Europe for some time. And a lot of that still depends on what Mr. Putin does next. And I think the big question right now with his back to the wall is, does he go after oil, which has very negative implications for Putin internally? And he's using oil to subsidize the war, and he's also using it to subsidize the domestic subsidies. And they've run out of a lot of their spending down their reserves pretty quickly. So he's in a spot where he has to make some decisions. Oil could be the non-nuclear option before he pushes to tactical nuclear, if he feels he has to go that way. That could be crippling for Russia first. It will probably be a big benefit for India and China, because they're going to be sucking his oil out at very low prices. But they were clear this week that they're not as engaged in supporting the Russian effort as I think Mr. Putin would have hoped. So I think that that puts us in a really awkward spot where you don't know. The range of outcomes are quite binary with where he goes with the war right now, or what is he calling it, a police action? I never get that right. So I don't think we're going to get to firmer footing in any of the markets until we see the peak in inflation and the peak in interest rates. I think the market has it wrong in the US that they were expecting the Fed to lower rates. If the Fed does 100 basis points tomorrow, it's a sign that they want the market to know that they're going to keep rates at a steady level for a while. They're not going to make the mistake of the 70s, and they're going to kill inflation because they don't have the bullets if they don't kill it now to deal with it, because we've spent a lot on monetary policy, we've spent a lot on fiscal policy, and we got very little back for it and very little productivity improvements out of that. So they need to kill inflation because they don't really have the power to deal with it otherwise. And I think that puts the policymakers in a tough spot because they don't have any bandwidth to do fiscal stimulus to any great degree and get big bang for it. And they have big needs right now. We have a lot of people in food and energy crises right now that are, and it's not just in Europe. It's, I think one of the real unfortunate parts is around the world, the least fortunate, whether it's a nation, a company, or individuals, are going to really suffer for this. I think the wealthy will be hurt, but they'll be hurt to a lot lesser degree. And that just creates bigger tensions on politics, which makes it harder to get the right policies in place, particularly when you need long-term policies, not short-term fixes. There absolutely has to be, we're going to have to move off these low unemployment levels to higher unemployment levels to deal with the inflation. You can't have both. We'll go back to a wage inflation spiral like we had in the 70s, and we can't afford that anywhere. So I think that's going to be a big issue. I mentioned the rate structure changes putting a lot of pressure on valuations, and I think we have a global reset of asset values in every asset category. Some will lag the others, but where the opportunity is and where it's knocking, I think, is in the electrification, the digitalization, national security, essential commodities, which have gotten slaughtered lately. But I think they are the key to getting out of this. And I think when I think about national security, I think about not just border and military spend, which is absolutely going to go up and go up big. I'm thinking about food security, energy security, and cybersecurity playing a much bigger role in where we are. And to get those things going is going to, and the digitalization and the electrification is going to require those essential commodities, which puts us at odds with the greening of the economy. And I think that's one of the problems that we've had is we had a wish without a plan to get green, and now we're going to have a plan that includes both. And you're starting to see much more reliance on the traditional fossil fuel companies to get involved in the energy transition, which I think is a good thing because we're now bringing in their expertise of what they have a history of. I think there's another category that I want to highlight, and we see this in our flagship strategy at ARS. We have a 30-stock portfolio, and 5 of the companies in the portfolio are in a process of doing buybacks of anywhere between 15 and 30% annually. Think about that, 30% buyback, 3 years to 4 years, you can take your whole company private. And I think you're going to start to see that really push because their investment choices are going to be more difficult in this. And because their investment choices are going to be more difficult because their consumers are in a more difficult spot. And one of the challenges we have that policymakers are going to be faced when you're facing financial crises, everyone pulls in the oars at a time we need spending. So the paradox of thrift starts to come into play. And you start to see people saving when they should be spent, when we need them to spend. Fortunately, I just saw on CNBC as I was coming over some really positive things coming out of a lot of the credit cards. Amex was out today saying that they're seeing international travel pick up and spending on that pickup, which is a good sign for the economy. But others are seeing very strong Visa, and some of the banks are seeing very strong consumer spending right now, which says that it's not as bad as everyone thinks, but we're at one of those, I think, critical junctures where we either go one way or the other. And we're going to have, you have to drive defensively, but I think there are real opportunities there. As I said, 5 companies buying back that much of their stock, it really doesn't matter much what the Fed does or what is going on in the rest of the world when you can control your own destiny like that. And lastly, I'll just close with, we do believe the US is the best positioned major economy. I think India is in a particularly good spot as well. They're kind of in the middle of sucking the cheap oil out of Russia at a time that they need it. but they also have a lot of the core features that a nation needs to really do well for the long term. And they seem to be setting up is India now not quite what China had, but a kind of a distant second that gives them a positive view forward, I think is a real opportunity there. I know we've talked a lot about Africa, and I think there's going to be some significant opportunities there, but there's always significant challenges. So you just have to make sure your risk rewards are going to be appropriate wherever you go. And I think that's the big issue. I think we have to think about risk very differently than we did at any point in time in the last 12 to 15 years. You can even go back and say back to right after the tech bubble when we really took rates down the first time. So Mark, I'll stop there and open up for discussion and criticism. Always happy to get it.
All right, questions from people here on Zoom?
There's something in the chat. Oh, that's the deck.
He's a dead cat. Well, we had one of our cats.
When will they be able politically to do that? Because obviously they need to do that.
That's a great question. The question is, when do you think we'll move back off of the net zero policies by governments? And I think each government's going to be different. I think what's happening right now in Europe is a real eye opener for ideology versus practical implementation of a policy. And the problem with the green transition in the near term is it's inflationary at a time we don't need to add inflation to the system. It will be deflationary eventually, but it starts out as inflationary. And I think that is
our London 2019.
That was the question back then. That's right. And so I think that pressures them in a different way.
I call it transition, the green transition. I call it green destruction.
There's a lot of different views on the call, so I try and play it down the middle.
Andrew, you had your hand up?
Yeah, with that in mind, Stephen, I guess it's more of a comment that with respect to fossil fuels and the green movement, without getting political, it seems to me that they have always and will continue to play a role. A quick reference to that is so much of what drives the electrical grid to charge these cars are by the likes of big coal burning companies. Am I wrong on that?
They play a role.
They do play a role.
Gas.
I think coal is the one that if you look at any of the statistics that are being put out, coal's the one that goes first, gets knocked out first. But I think the natural gas and oil is going to be
It's back in Europe now for the winter.
well. And when you want to heat, you'll do whatever you can get your hands on. I think that's the other thing that the world's at war, not just in Ukraine, but there's a big economic wars going on right now, and I don't think we've acted and governments have acted like we're at war, and they have to be thinking differently about what they like to do versus what they need to do, how you balance the two off. And then how do you do that and get reelected? It's very hard because, if it's kind of like we like to talk about, if you talk to somebody who's a chief technology officer about cybersecurity, if they spend a lot on it and they get hacked, they get fired. And if they don't spend enough and get hacked, they get fired. I think that's the problem governments are having right now is if you go too far, too fast, and it doesn't work, you're going to not be reelected. So I think that's the other challenge. The governments are really working towards election cycles on a much greater basis than they had in the past. And I think that whole short-termism that we've gone through is a big problem. And I think that's really what's in place. So it's going to depend on each country.
For what it's worth, you and Mark do a great job of playing it down the middle, as you said. So thank you.
Well, we think about probabilities at ARS. So, and this has been a humbling year. So anyone who's too confident has a lot of egg on their face. I have enough without being overconfident. So I do think that the challenge, though, is that everyone's a little right, but everyone's a little wrong too at the same time. And we argue about, I think, the wrong things. I look at the US immigration policy. Our politicians argue about absolutely the wrong stuff. And we have demographic issues. And I think this is a problem around the world. How do you replace the workforce when the aging is going on as fast as it is? I saw a statistic yesterday that China's average age since 2000 has gone from 68 to 78 years. Now, that's tough on a 1.4 billion people, and you need young people coming in, and that one-child policy, all the stuff that we know is out there. That puts them in a tough spot for a long time, which is why they're bringing in as many robots. So I think
Russia deals with that too on a big level, don't they? The mortality rate in Russia.
yeah, Russia's statistics are really awful and almost third worldly. They're moving to their mortality rates and other things look really bad, and there's some statistics that are put out by international agencies that's ranked the violence and the death and the other stuff there, behind third world countries, and that's not where any major economy should be. And Russia's 10th, 11th, 12th now, so they've come down a bit, but that's a long way from 170 or 180. So I think
Well, you also have a significant brain drain going on in Russia that's been accelerated. That brain drain's been going on for a long time, but the war has significantly accelerated that brain drain. So you've got a lot of young youth and wealthy people just leaving the country, going to Dubai, coming to the United States, London, wherever, Uruguay as well.
Georgia.
Yeah, I think the real turn came when Simon Vine moved. When was that, Simon? 20 years.
December 2018. That was there.
That was the turning point.
And by the way, when I left, we couldn't talk to in the States.
Yeah, don't leave.
Other comments?
Mark, I've got a question for Stephen. You identified 5 themes. Do you and your colleagues within your firm have one specific or several specific names that are best reflective of progress or potential within those themes?
We like to think so. No, yes, we do, but we do. But
And can you cite them? Not that we want to run out and buy those, but just to dimensionalize that exemplify good forward movement within those themes.
Maybe 1 or 2.
yeah, I think Freeport McMoran, which has gotten slaughtered lately, is in a very interesting position because copper is so essential to digitalization and electrification. It's going to be very hard to see how the world moves forward without really pushing forward on copper until they find an alternative that is better than that. And people are working on it, but it's not here yet. I think that would be one. I think the chip space, which has gotten hit pretty hard lately too, is still at a really attractive area with great cash flows, strong balance sheets, and the ability to buy back massive amounts of stock. They're in 2 camps: the digitalization and the special situations, because you can find companies that are doing really interesting things there as well.
Would you include Intel then on that?
We don't. So we were in it for a while. We're not as enthusiastic about their prospects as others.
Is it too big? Not to oversimplify.
No, I think they're too far behind actually to get started. I think some of the smaller, more nimble companies and more focused companies have done a better job and have better positions. And I would say, don't lose sight of the Apple, Microsoft, Amazon, Google. They are massively uniquely positioned to benefit from a lot of the big trends here that are at play. So I think that's a really interesting area. IBM, we're less enthusiastic about. We like their dividend, but the stock hasn't done anything in a long time. The Buffett effect didn't last, and they never really levered. Were able to monetize the AI start with Watson and all that. They just never got it where they wanted to be. And then when they brought in the last big acquisition was of VMware or Mike, who was the big acquisition for
Red
IBM? Red Hat. That they didn't really get that into where they were going to get the benefit from that either. So I think that's one of the challenges. We still like, the chevrons as well for the electrification, because you to get the transition, you're going to need to power the world up while you're going along. So a chevron is an interesting one. EOG or Pioneer are all, I think, really attractive businesses. And I think that's one of the things, people are too focused on stock prices as opposed to the businesses. And these businesses are really very attractive right now. BP is another one that, from a real problem has gotten more attractive.
Have you looked at Chris White?
I think if you're looking at the energies, Chesapeake is cheap right now compared to most of its peers.
Yeah.
Maybe they should be, given their history of, let's say, duress. But it's not clear to me that the history means anything going forward. So
Yeah,
that's kind of interesting.
Yeah, we owned that for a long time, back when Barbary was doing the right things. And then we haven't gone back to it yet, but there's a lot of opportunities in the fossil fuel area that I think people should be really thinking about.
Stephen, do you pay any attention to Good RX?
I'm sorry?
Do you pay any attention to Good RX? The discount prescription drug gig?
I've used it, but haven't looked at it as a stock.
Okay.
Chris, just on your, on the oil and gas sector in the public markets, are you the only company that's raised capital in the last 12 to 18, 24 months?
No, but it's a very short list, Mark. And so we have a big chunk of the equity capital raised publicly in the world in the last 3 or 4 years. So it's actually astounding. You think about it. Now,
You raised how much? 100 billion?
sorry?
How much have you raised in total?
Oh, in public equity, let's see, about $430 million in the Brazilian subsidiary.
Right.
Private equity, about
Well, I know that. I know that.
dollars in a couple of other deals. Debt,
I'm sorry.
I don't know, 600 million or something like that. So
Yeah.
we
Well, last question. What multiples are you trading at now?
just over 3, Mark, which enterprise value of just over 3 times EBITDA in Brazil. Now that sounds cheap, but you look up here in the energy space and there's a bunch of quality energy, smaller, especially quality companies trading at the same kind of values.
And what's the forward curve on WTI?
Oh, geez, I haven't looked in a long time. It's probably 65 at the terminus, something like that. So, and that's probably too high for a cycle average price, in my opinion, anyway. So, so you're looking at this sort of steeply declining futures curve, which
Your
curve has been shaped like this for a long time, and it's sort of been sliding to the right and bouncing up and down, if you like, on the thing, which is a very odd dynamic. Makes it very hard to hedge, right? You're looking at real difficulty here, giving up, $20 to the current market kind of thing is.
Chris, I was asked in London, I'd like your take on it. Do you think if the world needed more oil, would the U.S. energy producers start to ramp up their production now?
They're all listening to their shareholders. So you
That's a
should
definite no.
You should call.
Production per, hi, Andrew Randak here. Production per the IEA globally is way up, US in particular. So millions of barrels since the invasion, and several million barrels since late last year. So oil, at least IEA is saying that oil consumption and production are in equilibrium. So that's September 6th report, something like that. You can look it up on their website.
Yeah, but I think the issue, if they needed to produce more now, would they? I think it would be on the margin. I don't think they would step in if there's talk. There's talk that Russia might move towards their next step of cutting oil production by 2 million barrels, which would be a little bit of suicide for them, because it's when you shut down production, it's hard to get the returns back up again. But I think that's going to be that's where the question stemmed from, and I'm not sure. I think Chris is right. I don't think these guys are going to overspend for something that they think is going to be not long term.
Well, if you think about it, for the people that have been in this business, the guys running public companies have been in this business a while. I mean, you don't end up running a material public company, 3 months out of business school or something, as a general proposition. So when the oil price crashed in 2014, and before that, the idea was more, grow, drill as many wells as you can. And it turned out to be a fool's game, because everything was done with calculated rates of return based on $100 oil or $120 oil. And the realized price on those barrels turned out to be on average 55 or something on that thing. So it turned out to be a really bum deal. And everybody remembers it. All of the shareholders remember it. It led to essentially a lost decade in the oil and gas business in terms of return to shareholders, where for an entire 10-year period, the returns were, what's a good word for shitty? So, Stephen, you're in the business. Tell me, what should I? They were crap. They were lousy.
Yeah. And the other thing is the banks have choked off the financing to them. So, they would either self-fund it for short-term gains when they can buy back stock. And it's a pretty straightforward deal for them, what they're going to do.
It is. And the banks, you think about what happened with the banks, the same thing happened. They're doing this 3 or 3.5% margin reserve-based lending stuff. And then boom, a whole bunch of these companies went bankrupt. And you cannot make a living that way. That's just not enough margin to make a living on if you're going to lose the bottom 15%, in a downturn. What happened? So so I don't think anybody's going to be in a huge hurry in the States to ramp up production. I think
Chris, can you hear me?
going to remember all the things that were said to them.
Chris, Simon has a question for you. Simon?
Yes, Chris, what do you think about an idea that the Russians have to reduce the oil production to satisfy the Iranians? Because now both of them are selling to the same channels and they want to remain friends. I'm just asking out of curiosity, is it possible?
Boy, I can't begin to answer that. My opinion on that is no better than anybody else's. Go ask somebody on the street, Simon. I haven't a clue.
I read something yesterday from is it John Locke, who is the former head of NATO in Moscow. His view of what happens next is Russia's going to continue to do their attacks on civilian targets and then start to look at possibly cutting off, in addition to natural gas, oil. But if they go to oil, they're, as we talked about earlier, they're going to be hurting their domestic economy and their subsidies for the domestic economy. The reserves are way down, so they need the oil revenues and they need to fund the war. So they're not in a great spot to cut production too much, even though that's a threat that they're going to make.
Right. My question is a little bit different. So, assuming that most of Russian oil is now sold from tanker to tanker, it is probably sold, it's my other guess, it's probably sold through the same channels through which the Iranians sell. So Iran is kind of an ally of Russia, right? One of the few remaining. So by doing that, they're kind of competing head to head with Iran. So suddenly that becomes another leverage in the U.S. policy against Iran. And as long as you don't give up, all Russian oil will basically destroy your oil altogether. So, but then the question is, since neither the Russians or Iranians want to give the United States any extra chips, maybe they will just agree on the voluntary price reduction, or production reduction.
The one thing that goes against that is the Saudis are very big on price stability to the best they can have it. And that would put pressure on OPEC to really offset that so that they don't benefit the way those two countries don't benefit the way they'd like to. And if they did that, if the OPEC increased production while they were reducing it, they would actually just be cutting off their nose to spite their face when they both have internal financing issues.
Right, but how can does Russian oil in a big way impact the OPEC oil? Because now Russia cannot sell in the same channels as OPEC, if I understand correctly.
But it goes to global demand. So if it's still, 100 billion barrels a day, 100 million barrels a day. And if it's not Russia or those guys supplying it, it's going to be OPEC or the US. So,
Which is good for OPEC, right? They will be selling more oil at higher prices.
yeah, they want stability. The Saudis really want stability. Price stability for them is as big an issue because it leads to social stability for them. The better they can control the price, the better they can control their subsidies, their population to keep everybody happy. And I think that's the issue that a lot of these countries are facing is with limited finances or financial stresses on their balance sheets of the government, how they provide the subsidies to how they stay in power. I think that's a big challenge.
I haven't verified this or researched this, but something I read the other day is that half of the oil that Russia would usually sell to Europe remains unsold, which I found interesting.
No, that's a big number. That would be 5 million barrels a day, Chris, if it's half. They do that.
No, I don't think there's been much impact on the overall volumes coming out of Russia at all.
I think it's just going to different places.
It's going to China and India and Malaysia, and
Indonesia, no.
Yeah.
Chris, a quick question on some of these alternative energy sources. Hydrogen comes to mind. What's going to happen with these industries as we move through the next few months? Are they going to go away?
Yeah, so when they release it.
well, hydrogen, good Lord. This is a question that you ought to ask my unborn grandchildren. Let's put it that way.
Fair enough.
I think those bets that's research that's going to continue in different forms and fashions. Nothing's going away.
I think there's going to be a bigger push to cleaner with the fossil, with the hydrogen, with all that. They're just going to. What they should have done all along was leverage the expertise of the producers that have, 50 years or more of experience in production, and find better ways to do it safer and cleaner and cheaper. But
Capital. And capital to back those efforts.
Any other comments, questions?
Oh, and one thing that I just checked, I read something that somewhere in the Nordics, they have a huge adoption rate of the heating pump. versus here in Germany, it's still oil and gas, right? So I actually checked this, and it says that in Norway, 60% of the households use a heat pump, right? So there are these trends that are, coming up from a low base, starting in a little country like Norway. But I also know in Germany, there's a huge demand. They're all sold out. This will, in the long term, certainly change some of the dynamics.
What about consumption? Is there any move toward being smarter? I mean, I saw that there's public transport has been subsidized.
Yeah.
Can that make a meaningful dent?
Yeah, so they now had the €9 ticket in Germany for a couple of months. And so what they figured out is, even though a lot of people were using it, the car traffic actually didn't go down that substantially or as suspected. They're now discussing a succession to that. There will be one. They're still fighting about the financing. There's now something like, they say, €29 or up to €60. But I do think it will shift slowly but steadily.
But your chemicals industries can't.
Pardon?
But your industrial economy can't shift like that.
No, of course not. Right? Yeah. So this is still the issue. You need gas for aluminium, steel. You need even for brewing beer, which would be a major catastrophe if that production line would be affected.
We're probably 10 minutes away from here. But what about Jim? So we talked about the prospects of inflation and then recession. Have you give us a sense of how you really faring in the next year or two?
Well, the inflation is already up, and it will continue. There will be also some political pressure because the parties on the extreme sides, on the left and the right, they all make propaganda for, this is going to be a hot winter. We have to protest. This is about social, where we have to fight about this. So, some protests could happen.
Is there any push from the population here for Germany to get more aggressive and more supportive of Ukraine? They seem to be holding back a little bit. And I know the defense minister came out with a pretty strong position that you need to do more. And that goes against her own party.
Yeah, I think the general opinion is that Scholz is holding back too much. People would be in support. However, what Scholz all the time says is, look, the US isn't sending their Abrams tanks. We are waiting for that. We don't want to be the first.
Yeah, I think the ambassador from the US said that each country should do it on their own and not wait for the US to do it. And I think that's been the big gripe about Germany throughout this process, is they haven't stepped up as a leading nation to lead in